Now let's talk about the Indian markets. What draws an investor to the share market? The hope of outsized returns, of a stock that will double, triple, even quadruple their returns. Investors call these stocks multi-baggers. They're like unicorns for investors, very hard to find. Do you know which is the best time to grab these investments? When a company goes public for the first time, when it opens its IPO, initial public offering, it's the first time a company sells its shares to the public. Indian markets are buzzing with IPOs. Many big ones are lined up in the coming months. Car maker Hyundai is among them. Hyundai's India unit is gearing up for its IPO. It could be launched next month. Reports say Hyundai India could be worth $20 billion. The company wants to raise some $3 billion in this IPO. This could be India's biggest ever IPO. Right now, the record is held by LIC, that's Life Insurance Corporation of India. LIC is a state-owned entity. It is India's biggest insurer. It went public in the year 2022 and raised some $2.7 billion. If Hyundai raises $3 billion, it will beat LIC's record. Hyundai is one of India's top car sellers. It is also India's largest passenger car exporter. Hyundai's India arm exports cars to more than 80 countries. And of course, there is a brand name. Hyundai is one of the most recognizable car brands in the world, as well as on Indian roads. So when Hyundai makes the announcement, expect investors to make a beeline for this stock. In fact, that's been the case with most IPOs this year. More than 150 companies went public in the last 9 months. Together, they have raised close to $5 billion through IPOs. There is great investor appetite for new listings. And the reason remains the same. The possibility of outsized returns. That's the mindset of most investors. You see, when a company goes public, when it offers its shares to outsiders for the first time, a lot of investors see it as a money-making opportunity. They want to invest early in the hope that they'll get the shares for cheap, since the stock is just entering the market. And once the company goes public, when its value starts to grow, the investors will make an outsized profit. That is the hope, that is the approach. Now, SEBI recently did a study about this trend. SEBI is the Securities and Exchange Board of India. It's India's market regulator. It found that around 50% of investors sell their shares within a week. Within a week of buying an IPO, they sell it. And which investors are these? Retail investors. They engage in what experts call flipping. That is not illegal, but it doesn't always work. It doesn't always make money for you. For instance, you buy shares in an IPO, and then when the company lists, the share price tanks. And this has happened with many recent listings in India. So there's no guarantee that investing in an IPO will make you a quick buck. But retail investors remain vulnerable to speculation, and SEBI is worried about this. It is scrutinizing some recent IPOs, and this is according to a Reuters report. It says SEBI is probing 6 investment banks. These banks helped some small businesses go public. What is SEBI investigating them for? Apparently, these banks charged a higher fee during the listings. What does that do? It leads to oversubscription of an IPO. It creates artificial demand. Apparently, fake bids were made for the shares of these companies to drive up the demand and to attract more investors. We'll have to wait for the final outcome of this investigation, but SEBI is already tweaking the rules. It is introducing more checks and balances for IPOs. So the next time you think about applying for one, look through the listing carefully and think twice before you invest. Not everything that glitters in the stock market is gold.